America's insurance regulatory framework was responsible for the protection of insurance consumers and companies during the U.S. Financial crisis and has only improved in the 6 years since. We have increased our dialogue with foreign regulators, including participation in supervisory colleges, gained a better understanding about how other financial companies are or aren't regulated, and recently completed the solvency modernization initiatives, all in about 5 years, and all of which strengthen our system while preserving the elements that fundamentally work well.
State insurance regulation works because it is specific to the industry's unique risks. States are able to evaluate specific company risk with different methods for life, health, and property and casualty insurance, giving deference to unique demographic and geographic factors.
Today, more than ever, we are better equipped to identify and rein in activities that could put policyholders and the financial system more at risk. Capital is an important part of our system. Following a number of insolvencies in the 1980s and 90s, we set to work on building a capital risk-based system and improving the financial reporting and analysis that goes with it. We ensure that all legal entities within the group are separately capitalized so that there are assets to pay policyholder claims regardless of what might be happening within the group. This legal entity approach is like multiple bulkheads in a ship, ensuring that losses or damage in one area does not spill over to another, helping to keep the entire enterprise afloat.
Unfortunately, some in the U.S. and overseas who don't understand or appreciate the sophistication of our system seek to overhaul the current structure. Proposals include adding burdensome and costly layers of regulation while stripping away the flexibility that has served consumers in the industry so well. As we have seen with the Financial Stability Oversight Council, FSOC, those regulators with banking expertise and experience are treating large insurers like banks.
It's policyholders, consumers, you all, that ultimately underwrite the cost of any changes we impose, and will further be impacted if our actions lead to consolidation, less competition, fewer product choices, and higher prices. There has been, in my opinion, far too little attention to the cost of whatever benefit we hope to achieve at the international level. Any international standard should not favor one regulatory approach over another. Instead, it should represent the best outcomes that solid regulations provide and leave it to individual jurisdictions to develop their own best way forward. Given the difference in regulatory structures, authorities, accounting, and legal environments, a single uniform standard is unlikely, and I would argue unnecessary if we can all work towards a high level of consistency while preserving the diversity in regulation that makes for a stronger, more resilient marketplace.